Hello everyone. Good morning to all. Everyone joined fast. Okay, everything is good. Audibility and visibility is also fine. Now, so today we have to start the marathon session of Module B. So yesterday we did Module A, and in Module A total we have completed 46 questions. So I hope you all have watched that session. Now today we'll start Module B. Few questions would be numericals. Every type of numerical we will do one question each, and a few theoretical questions. So total 35 questions we have in today's session. And if you are new to this channel, I highly request you to please subscribe the channel. And if you feel sessions are helpful, then do like the session. Now, so this is our capsule batch. So if you want to watch the session in bilingual, then you can watch the Pradyuman sir class, and in English, then you can watch my class. So last minute revision session, where in 7 days we will complete your entire, not in 7 days, in 6 days, we will complete your entire ABFM paper. So we have completed module A so far and one unit of module B in 2 lectures. And today we'll try to complete module B in our paid classes. So if you have not yet enrolled, do enroll now. So 12 hours of live marathon session you will be provided, and with that, additionally, you will be provided ABFM mock test as well. Now, so let's start with the question. The questions which are of a red color, they are your previous year question, and the black color are your normal questions. Now, so this is your previous year question. Select the statement which explains the significance of financial leverage. So we have three types of leverage: financial, operating, and combined leverage. The financial leverage talks about financial risk. The debt operating leverage talks about the business risk, the operating expenses, operating cost, and combined leverage talks about your financial plus business risk. So combined is also known as total leverage. So statement first, it says that means if business is conducted without debt, result in lower EPS. If any business is conducted without having debt, without having loan, then it result in lower EPS always. Strategy to enhance EPS is by borrowing instead of bringing shareholders' equity. Statement 3, cost of capital to buy more asset is lower than value, then it is a type of income gain from the additional asset, or the ratio of shareholder equity funds to total debt should be kept equal for financial leverage. See, if any business is operating without having debt, without taking risk from, without taking loan from any financial institution, it always not result in lower EPS. Okay, EPS, your earning per share will, if sometimes it will be high, sometimes it will be less. So it does not mean that it has the impact on debt. So debt, it will increase your earnings also, but at the same time it will increase your risk also. How earnings? Because if you are taking more debt in your company, then you will do more business and more profits you will make. But at the same time, you have to pay interest also. You have to pay principal amount also. So the burden of interest will make the company more risk. So it result in lower EPS. No. Now, strategy to enhance EPS is by borrowing instead of bringing shareholders. Now, we have studied several times that debt is what? Debt is a cheaper source of finance. So if you want more money in your company, then you will take debt instead of taking the help from your uh, shareholders, equity shareholders. So it enhances your EPS by borrowing instead of bringing shareholders. Yes. Now, cost of capital to buy more asset is lower than the value, then you will be having income. So suppose cost of capital is having 18%. Okay. And it says the cost of capital to buy more asset is lower than, let's take an example, cost of capital 15%. If it is lower than the value, means the value you are getting 18% and cost of capital for acquiring those assets is 15%. So if your earnings more than the expenditure, then it is what income for your company. So this is also correct. Now, ratio of shareholders equity fund to total that should be kept equal. No, it is not that you have to keep it equal or you have to keep it more or less. So statement 2 and 3 are correct and 1 and 4 are wrong. All right. So these are all your explanation part, why it is wrong and why it is right. Now, next question. Question on decision tree analysis. A company faces a decision what to launch a new product or not. So company is making a decision whether to launch a new product or not. If it is launched, there is 60% chance of high demand. And if there is 60% chance of high demand, then profit would be 4 lakh dollar, and 40% chance of low demand, then profit would be your 1 lakh. If you have not launched any product, then there will be zero profit, $0. The company can also conduct the market research for 20,000. So if you are doing market research, then it means your cost is more. You have to do more expenditure for market research. Then only you will get the perfect demand. Now, so what is the expected monetary value? You have to find the EMV, expected monetary value, if the company launches the product without market research. Here it says that you have to launch the product without considering market research. So it means we will not going to take this consideration 20,000 in calculating our decision tree. Now, so what is the 60% chance is higher profit? So 44 lakh into 60%, 0.6 plus 1 lakh into 40%, 0.4. If you will add this, then and market research is what 20,000. So now here we have to what? We have to launch the product without market research. So we will not going to add this 20,000 will not be added. So if you will calculate, then 0.6 into 4 lakh plus 0.4 into 1 lakh, that is 2 lakh 80,000. So this is without considering your market research. If you consider your market research, so you have to add the 20,000 here also. So 2 lakh 80 plus 20. So it would be 3 lakh dollar. But without market research, the answer is 2,80,000. So decision tree analysis helps visualize sequential decisions and outcomes. So decision tree is what? It is just the diagrammatical form where the company can easily make any kind of decision related to their product and services. I guess it's not visible. All right. Now, next, question number 3 and question number 4. A firm's degree of operating leverage, a percentage change in EPS if its sales increase by 10%. So DCL is how much? DCL means degree of combined leverage, means degree of operating leverage into degree of financial leverage. Now, OL and DFL is how much? Degree of operating is 2 into financial is 1.5. So it is 3. So this degree of combined leverage is what? 3. Now, degree of combined leverage, what is its formula? Percentage change in EPS upon percentage change in sales. How much changes you are making in sales and how much changes it is happening when you are making any fixed amount of changes in your sales. So if you are making changes in sales, how much your EPS is changing? That is degree of combined leverage. Now, so degree of combined leverage, we have got how much? It is 3 equal to. Now, percentage change in EPS not given. We have to find this. change in EPS, and how much sales is changing if sales is increasing by 10%. So percentage change in EPS would be 10 into 3, that is 30. So option C is the correct answer. Clear? Now next question says Z Limited has sales of 5 lakh, variable cost 3 lakh, fixed operating cost 1 lakh. This is very easy question. All the values are given. Simply you have to find degree of combined leverage. So degree of combined leverage formula of DCL is, because all these values are given, not any percentage change is given. So we will apply which formula? That is contribution upon EBT, not EBIT. Now, so first find the value of EBT. Sales are how much? Sales are 5 lakh. Then sales minus variable cost 3 lakh. So you would get 2 lakh. Then fixed cost 1 lakh. How much is left? 1 lakh. So these are your sales minus variable cost, contribution minus fixed cost, EBIT. Now, in EBIT, I'm calculating here. EBIT is how much? There is space? Yes. EBIT comes to 1 lakh rupees. Now, minus interest. What is the interest? Interest is given 40,000. So 60,000 is your EBT. Now, so degree of combined leverage, that is contribution was 2 lakh. Contribution upon EBT. So 2 lakh upon 60,000. So that is your calculate 2 lakh divided by 60,000. So it is your 3.33 times. So this is your degree of combined leverage. All right. Now, so this is your answer. So 3.33, that is option D is the answer. Now, this is your summary for all the types of leverage. Operating leverage formula is contribution upon EBIT. Financial leverage, that is EBIT upon EBT. Combined leverage, contribution upon EBT or OL into FL. Now, what it measures? Effect of sales change on EBIT. If we are making changes in sales, what would be the change on EBIT? In operating leverage, if there is change in EBIT, what would be the change on your EPS? How much your EPS will change? And if you are making any changes in sales, then what would be the result on your EPS, on your EBT? That is combined leverage. Now, so all these are the differences between operating, financial, and combined. So operating leverage, effect of fixed operating cost, here fixed financial cost, and it includes both your business risk plus your financial risk. Business risk, financial risk, and business plus financial risk. Formula is percentage change in EBIT upon sales, percentage change in EPS upon percentage change in EBIT, and CL is percentage change in EPS upon percentage change in sales. It analyzes the sensitivity of EBIT due to sales change. When you are making any kind of changes in sales, how much there is change in your EBIT? If you are making changes in EBIT, what would be your result on EPS? How much it will change? What is the sensitivity factor of EPS? Similarly, if you are making changes in sales, then what would be the sensitivity factor of EPS due to change in sales? So high change in EBIT will lead to small change in sales, high change in EPS with small change in EBIT, and high impact on EPS when there is small change in sales. So if any small changes in sales are making, then there would be high changes on your EBIT, high changes on your EPS in combined leverage. All right. So these are the difference between all these. Now, next. Question number 5. The debt service coverage ratio DSCR of a company is 0.8. Now, what does it mean? If company's DSCR ratio is 0.8. Now, debt service coverage ratio, what it says, it basically says that company is having how much money, company is having how much funds so that it can pay its obligation, that is debt. Debt is what? That debt is a form of obligation that companies they have to pay to the bank, they have to repay. So debt service coverage ratio of a company, if it is zero point 0.8 means if it is less than zero point 0.8, it means company does not have enough funds to repay its debt repayment, to repay their obligation. So if it is zero point 0.8, the company's net profit is 80%. No. Company has sufficient cash. No. Company does not have sufficient cash in this case. So company's operating profit is insufficient to meet its scheduled repayments. So option C is the correct answer. Now, next question number 6. So company is planning to increase its operating leverage. Now, operating leverage means operating cost, fixed operating cost, by automating its production process, which will increase its fixed operating cost, but it reduces the variable cost. Now, if it increases its fixed cost means the operating leverage will increase, and operating leverage measures what? The business risk. So business risk will increase. So these are all the answers and your explanation. Now, question number 7. All the models and theory, and you have to match. Now, Volter model has given what internal financing relevance, that if you will give dividends to your shareholders, then your value of company will always increase. That is Volter model. Now, Gordon has given the constant dividend growth. Modi, Gilani and Miller approach has said that dividend after profitable projects, and residual theory says dividend after, and theory gives you, wait, just let me correct this. Now, Volter model, internal financing, Gordon model, constant dividend growth, theory says that dividend is irrelevance, and residual theory gives dividend after profitable project. So you have to always distribute dividends after you have done investments or after you have invested on any project. So whatever amount is left, whatever profits you have made, then only you will pay all your dividends. Now, so Walter, it is 1, 4, 2, 3. All right. Now, next. It is 3, 2, no? Not 2, 3. It is 3, 2. 1, 4, 3, 2. 1, 4, 3, and D2. So 1, 4, 3, 2. Now, next. Question number 8. You have to find cost of equity with CAPM model, capital asset pricing model. So Gold Technologies Limited has equity shares of rupees 10 of rupees 12 each, amounting to 18 crore. Total value 18 crore. Now, current market price per equity share is rupees 75. Prevailing risk-free return means RF is given how much? Risk-free return, that is 6%. Average market risk premium is given, that is RM, minus RF is given how much? 7%. And beta is what? Beta is the risk. Risk, that is beta. So it is given 1.25. Now we have to find the cost of equity. So you have got risk-free interest rate, market risk premium, and beta. Simply you have to put all the values on the formula. Put all the values. So what is RF? plus beta RM minus RF. So RF risk-free rate is how much? That is 6%. Plus beta is 1.25. RM minus RF is already given 7%. Now calculate. So 1.25 into 7. So 6% plus 8.75 plus 6. That is 14.75%. So that is option D is the correct answer. Clear? Now, if your beta is greater than 1, it means the project is very risky. Beta is equal to 1, it means the normal on an average, means market is not that much volatile. You are investing rupees 10, you will get in return rupees 10. If beta is less than 1, it means no risk is there. Market is not that much volatile, or we can say low risk. Minimal risk is there. Understood this question? Okay. Now, next. So this is your next is you have to find the payback period. Company is considering a project with an initial cost. Now, initial. So what is the formula of payback period? Initial investment upon your annual cash inflows. This is the formula of payback period. Now, expected cash inflows are year 1 50,000, year 2 80, year 3 120, year 4 150. Now, see, there are two ways to find the payback period. If your even cash flows are there, then you will use this formula for even cash flows. But if the odd cash flows are there, even an odd cash flows means what? That you are getting 20,000 every year, the same amount, that is even cash flows. If in 1 year you are getting 50, second year 80, 1 year 20, so these are known as uneven cash flows. So for this, we will find the cumulative frequencies. So year in what is first year, second, third, and fourth. Now, what are your cash flows? So first year 50,000, second year 80,000, third year 1,20,000, and fourth year 1,50,000. Now these are your cash flows. Now you will find your cumulative cash flows. So cumulative means first year you will get the same amount 50,000, then 50 plus 80, that is 1,30,000. Then 130 plus 120, 2,50,000. 2,50,000 plus 1,50,000, 4 lakh. So if you will do the total, you will get 4 lakh here also. Now, and question says that initial cost is 2,50,000. Now we know that what is the decision criteria of payback period? Decision criteria is lower the better. Lower the better. So as soon as you will recover your amount, that is healthy for your company. So initial cost was 2,50,000. Now when you are receiving this 2,50,000, you are receiving in your third year. So 3 years is your payback period. All right, this we will use in case of uneven cash inflows. Now, suppose if okay, this is given 2,50,000. Suppose initial cost was 2,70,000. So similar type of odd cash flows, we have one question, so we will do later on. This one is clear. Even cash flows, how to calculate. All right, sure. Odd cash flows we will do later. Now, so these are your methods to find your payback period. Now, next, I find expected net present value using scenario probability analysis. When the value of the project is given 5 lakh and in three different scenarios. Now, NPV, the value of NPV, that if everything goes well best in the company, means everything goes according to you, then how much net present value, what is the present value that you will get, that is 2,50,000 of all your future cash inflows, and what is its probability that you will get 2,50,000, it is 0.3. Now in normal situation, when everything is normal, okay, not very much difficulties are coming, not everything is going very good, means it's a normal business, then how much you are expecting? You are expecting that I will make 1,20,000 net present value, and for this, and this is the value you have expected, and how much is the probability, the chance that you will make 1,20,000, that is 0.5. Now in worst scenario, that is minus, in negative you will make the NPV and chance is 0.2. Now how to calculate the expected NPV? So 25,000, 2,50,000 into 0.3, then 1,20,000 into 0.5 minus 40,000 into 0.2. Now, if you will calculate this, so 2,50,000 into 0.3, that is 75,000 plus 60,000 plus 40,000 into 2, 0.2, 8,000. So it is in minus 8,000. 5 plus 60 minus 8. So that is 1,27,000. Now, what is the decision criteria of NPV? If it is greater than 0, we will accept that project. If it is equal to 0, we are indifferent. And if it is less than 1, we will reject that project. All right. So you are getting more than 0, that is 1,27,000. It is in positive. So that is, we will accept that project. So NPV is 1,27,000 if we will use all these three scenarios. So we will accept that project. Now, next, question number 11. You have to find average rate of return. Now, average rate of return is also known as accounting rate of return. Formula: average PAT upon average investment. So this is the formula. Now, read the question. What are the values? What are the things are given, and then apply it. Now, which type of profit this ARR considers? It considers CFAT or it considers PAT. Which type of cash flow this accounting rate of method considers? So accounting rate of return, it considers profit after tax and rest all the method. Either it is your payback period method, or if you are having IRR, if you are having NPV, then profitability index, rest all other methods, they will follow your CFAT. Only one method that follows your accounting profit, that is average rate of return PAT. Now, so project requires an initial investment is 5 lakh in machinery with a useful life of 5 years. Now, no salvage value. Now, salvage value means this is your closing balance. So, if in question salvage value, scrap value, all these are given, it means that is your closing balance. Now, project is expected to generate an annual profit before depreciation and tax is 2 lakh. But we have to find first part. It is given PBT. Now, so annual profit is what? 2 lakh. Now we will deduct what? We will deduct the tax. See, already before depreciation it is given. So we will not going to deduct the depreciation again. If it is given after depreciation, then we would have to add, we would have to use this depreciation. Now, before depreciation and tax is 2 lakh. So we need to find profit after tax. Now tax value is 30,000. So it is 60,000. 30% of 2 lakh is how much? 60,000. So 1,40,000. This is 1,40,000. Now next is average PAT. How to calculate average PAT? That is opening average investment, opening plus closing divided by 2. Now opening balance is, see, if in the question scrap and salvage value given, that means it is a closing, but no closing balance is given. So we will, closing balance is what? It is 0. And opening balance is how much? Tell me what is the opening balance? Anyone? What is the opening balance? See, initial investment it is given a 5 lakh rupees. So 5 lakh is what? That is your average investment. So we have average PAT upon average investment. What is average PAT? Average PAT is 1,40,000. Just we have calculated. Average investment is 5 lakh into 100. So 1,40,000 into 100, 5 lakh. So that is 28%. So 28% is your average rate of return. Option C. All right. So first we have to find the PAT, and how we will find the PAT. See, already these the statements are given. Annual profit before depreciation and tax is 2 lakhs. So we have to find after tax value. So that is why we have deducted tax over here 60,000. All right. Should I move forward? So these are all your explanation. Answer is 28%. Now next, question number 12. When a US company evaluates a project in Europe, which factor must be considered to accurately calculate the project's NPV? So when we are investing in any foreign country's project, now which factor we will consider to find the exact value when we are using NPV? Projects euro cash flows, only euro cash flows, the spot rate, exchange rate, only US inflation rate, or ignore all tax effect. So whenever we are investing in any foreign country's project, we will include everything, not only cash flows, not only inflation rate. So see, it is written only and only. That is why these two options are wrong. And here it says ignore all tax effect. No. So the spot rate is what? The rate which is prevailing in the market right now. If $1 is 82 rupees in the foreign market, then that is your spot rate. After 1 month, if $1 costs rupees 87, then that this one becomes your spot rate. So spot rate is the rate that is prevailing in the market right now. So exchange rate, expected currency, depreciation and appreciation. So option B. All right. Now, next question. Question number 13. Which statement is incorrect about degree of financial leverage? When DFL is more than 1, financial leverage becomes relevant. A positive DFL means the firm is operating at level higher than the break-even point. EBIT means sales minus variable cost minus fixed cost excluding interest. And when DFL is less than 1, financial leverage becomes relevant. See, if you will see this question, two statements are these two are contradicting each other. Option A and option D. So either A will be correct or D will be correct. So in the question, it is which one is incorrect. Now, when DFL is more than 1, it becomes relevant. When DFL is less than 1, it becomes irrelevant. So DFL is what? That is a degree of financial leverage. Your debt, the which you take from any financial institution or bank. So when degree of financial leverage it is greater than 1, it means a small change in EBIT will create a big change in your earnings per share, and showing that debt is affecting how your shareholders earning. So it degree of financial leverage measures what? It measures your debt affect your EPS. And if it is equal to 1, it means there is no impact of debt in your company, no leverage is there. But if you're taking debt, if you're taking leverage in your company for doing your regular work, for doing operations in your business, so it will increase the returns to shareholders, but as well as it will increase your risk factor also. Because taking debt not only increases the principal amount, it also increases the interest value. You have to pay the principal amount plus interest amount. All right, so that is why when DFL is greater than 1, the financial leverage becomes relevant because the company is using borrowed funds. So it creates our interest expenses. So small change in EBIT will lead to big change in your EPS. So more than 1, it is relevant for the firm. So option A. And rest, this is also correct, this is also correct, this is also correct. Now incorrect was asking in the question, so D is your incorrect. So positive DFL means firm is operating at level higher than the break-even point. Yes, you have achieved your break-even point, and after that, whatever you are making, that would be your profits if it is positive. And EBIT, so EBIT means what? Sales minus variable cost contribution minus fixed cost EBIT minus interest EBT. So that is EBIT is equal to sales minus variable cost and plus all these amount. Excluding interest. It is not saying including interest. Means interest is not calculated over here. So if it says including interest, so this statement would be also wrong. Because we will exclude interest after EBIT. Then we will get EBT. So all these three statements are correct except the D one. So all the explanations are given. So as when the class gets over, I'll upload the PDF. So you all can revise it again. Now, next, project ranking by IRR versus NPV. Now, what is the decision criteria of IRR and NPV? IRR, if IRR is greater than cost of capital, then we select that project. Suppose IRR is 20% and cost of capital is 19%. So we will select that project. If IRR is less than cost of capital, we reject that project. Suppose IRR is 17 and cost of capital is 22. Now NPV is greater than 0. We will select that project. Less than 0, we will reject that project. Now, if there is the conflict between IRR and NPV, IRR is 20%, NPV is 1,80,000. Next, in next project, IRR is giving 17% return and NPV is great to 2,40,000. So when there is conflict between IRR and NP, so the project which is giving you higher NPV, higher value, we will select that project. So project B is selected on based on NPV. So higher NPV, we will select that project. No matter your IRR, internal rate of return, it is how much more than your cost of capital. So capital rationing would be greater NPV, we will select that project even if the IRR is less. Even if your IRR is less 3% less from the A1, still you will going to select the project B. So option D is correct. Now, next question number 16. Which of the following statements best describes between sensitivity analysis, scenario, simulation, and decision tree analysis? Now, what is sensitivity analysis? Sensitivity analysis, it basically says that if you are making changes in your one variable, keeping all other variable constant, then what would be the effect on the profitability of your project? Suppose I'm changing one variable sales. If I will increase the sales, accordingly my profits will also increase. Okay, my cost will be less. But if I'm changing decreasing my sales, so my profits will also be less. So how the changes are happening in other variables if I'm doing change in one variable and keeping all other variable constant, that is your sensitivity analysis. Now, scenario analysis talks about that in three different scenarios, what you are expecting, how much you are expecting in best one, how much you are expecting in normal scenario, and how much you are expecting in pessimistic scenario. So best is also known as optimistic. That if everything goes well in my company, then this is the thing which I will achieve. These are the profits which I will make. If everything is normal in my company on an average, if nothing goes well in my company, that is pessimistic or worst one. That is scenario testing multiple variables in three different scenario. Now simulation analysis is what it because you have to test multiple variables, number of variables, infinite number of variables. So in simulation you will use AI tools and techniques to find the exact value, and it will come in always probability because we are using various things. So the value will not always be accurate and authentic. And decision tree analysis is what? It is the diagrammatical representation which helps you to make the decision which one is good for your company, which one is bad for your company. Now, with this type of decision tree analysis, you can easily come to the conclusion. So sensitivity analysis changes one variable at a time and all other variables are constant. Scenario analysis considers few discrete set of variables. They are changed, they are being tested in three different scenarios. Simulation analysis, it uses probability distribution for many variables. You will change every variable, then you will do test, then you will experiment. And decision tree analysis, it is the map which helps you to make the accurate decision for your company. So option A. Now, next, question number 17. What is the correct sequence of activity-based costing? So, in activity-based costing means what? That in when you are making any product, when you are manufacturing any item in your company, you have to go through certain different stages. Now, when you are going through every stage, that every stage has its own cost. So, what is the costing? What is the cost you will going to face in every stage, in every activity? So that is known as activity-based costing. So first, what we will do in activity-based costing, we will identify main activities. Then we will collect all the cost pool like factory overhead expenses, then overhead expenses, the raw material expenses. Then we will determine the activity cost drivers to each expense, calculating the activity cost to driver rate, and then charging the cost of activities to each and every product. So option A is the correct answer. Okay, so these are all your answers. Now, next is arbitrage pricing theory question. Question number 18. Tell me. You have to find the expected returns. Suppose two similar international projects A and B have the same risk. Now both have identical betas. Identical means same betas to global GDP 1.2, inflation 0.8, and currency risk is 0.5. Now, so this is the beta given for GDP beta is 1.2, inflation rate beta is 0.8, and currency risk beta is 0.5. And to cover this, the risk, the companies they provide a risk premium to cover risk. If risk is high, more risk premium is provided. Now, without any kind of risk, how much you can earn from the foreign companies? You can earn 3%. That is risk-free rate. Now, what is expected return? So, risk-free rate plus beta 1 into risk premium 1. So, risk premium is given 2% of GDP. So, this is inflation is given, risk premium 2 is 1.5%, risk premium 3 currency is 2.5%. So, plus beta 2 into risk premium 2 plus beta 3 into risk premium 3. Now these are what? These are beta 1, beta 2, beta 3. Now put all the values. Risk free rate is 3% plus beta 1 is 1.2 into what is the risk premium given to cover this risk? 2% plus beta 2 is how much? Beta 2 is 0.8 into 1.5% plus beta 3 is 0.5 into 2.5%. Now calculate 3% plus 2.4 plus 0.8 into 1.5, 1.2 plus 0.5 into 2.5. So 1.25. Now add all these 3 plus 2.4 plus 1.2 plus 1.25. So that is 7.85%. So this is your arbitrage expected return from arbitrage pricing theory. Now, sometimes what happens, the the beta is given in negative. So you have to see that which one is positive, which one is negative. If it would be negative, then the negative answer would be coming, and accordingly you have to solve. So you have to remember the sign, the plus and minus, what is there. Okay, just have a look in this question. Any doubt? All right. Now, so 7.85. Now, next question number 19. Two statements are provided. So there are total 35 questions. Now, statement 1 says that FDI is considered a major source of non-debt financial resource for economic development and emerging economies. So FDI is what? Foreign direct investment. So FDI is when we are investing in any country or the other country invest in our country. So the investment which is made in order to acquire the assets of the company, in order to acquire the entire company, so that is known as FDI, to take more and more control of the company. This is correct. Now, FDI inflows, these are always permitted in all sectors? No, it is not always permitted. So in automatic route, it is permitted, but in government route, we have to take the permission of the government. So this is wrong. One is correct and two is incorrect. Next, question number 20. Which of the following statements are true? I have already shared all the PDFs of all the numericals. The formula of the formula PDF I have shared already in group. So of module B and module C, the formula PDF is shared. Now, which of the following statements are true? So, what is the first statement? The payback period method considers all cash flows of a project. See, we have studied in payback period that as and when you recover all your amount, that would be your payback period. Suppose you are getting the cash flows in first year 50, second year 50,000, third year 40,000, fourth year 40,000. So that is 1 lakh, 1,80,000. Now, and your initial investment was how much? That is 1,50,000. Now 1,50,000 and you have uh, your annual cash flows are 1,80,000. Now, whenever you will receive this money, that would be your payback period. Now, why you will go forward for gaining more and more money? So, payback period method considers all cash flows. No, it does not considers all cash flows. It considers only those cash flows when you have received your ultimate amount, your initial amount. Now, payback period concerns more with recovery of cost than profitability. Yes, it is concerned that as soon as you recover your initial amount rather than making profits. Net present value presents net addition to wealth of shareholders. Yes, and accounting rate of return, it includes it in methods incorporate risk as well as time value of money. No, ARR or and payback. ARR and payback period. These two are the method that does not include time value of money. They does not incorporate time value of money. So this statement is also wrong. So only B and only C are correct. Option 3. Rest all the methods they follows time value of money, your profitability index, your NPV, IRR, but ARR and PVP, that is payback period, does not considers time value of money. Now, next question number 21. In cost volume profit analysis, three statements are provided. CVP, fixed cost per unit decreases when production volume increases. Yes, as you increase your production, your per unit cost, your fixed cost will always decrease. While launching a new product, low sales volume increase per unit cost. Yes, if you will launch your product in the market, what will happen? Your low sales will increase your per unit cost. Means because sales are low, if sales are low, then your profits will be low. If profits will be low, your cost will be high. So it increases per unit cost. This is also correct. This is also correct. Now, statement 3, high pricing at launch always ensure early break even. See, if you are launching any product at high value, now, if you are launching product at high value, then less customer they will purchase our product. Not more customers will going to purchase our product because customers they always want the quality plus low cost. So if you are launching any product at high value, at high cost, then why your customers will be purchasing your product? They will be moving to some other place where that same product is provided at low cost. So it will always ensure early break even? No, because break even will be late because less sales are there, less customers are there, less money you will make. So you will attain the break even point after a very long time. So it always ensures early break even? No, not always. So this is wrong. 1 and 2 are correct. Now, question number 22, three statements are given. Make or buy is an outsourcing decision. Yes, either you will make your product and then you will do the sale of that product, or you will going to buy from the third party and then you will do the sale of that product. So it is an outsourcing decision. Now, in make or buy decision, very you will see that how much your cost is incurring, what is your opportunity cost, how much profit you can make. what is the selling price the other competitors they have kept. So in make or buy decision, you will see all these things. So all these things matter, yes. Now, cost already incurred in equipment is relevant. The cost which you have already incurred, like you have purchased any machinery for your business. You have purchased on 1st April 2025. You have purchased this machinery. Now, if you're analyzing that you have purchased this machinery, so the cost which you have incurred, it is your relevant cost because this the cost you have already done it earlier. You have already done it earlier in April, and you are evaluating. Let's suppose you are evaluating on 1st December. So the cost which you have already incurred that becomes your sunk cost, and sunk cost is always irrelevant. So that is cost already incurred in equipment is relevant for comparison. No, it is irrelevant for comparison. So this is wrong. 1 and 2 are correct. So it becomes your fixed sunk equipment cost. That is irrelevant. Now, see, one question we have done that when you are having the uh, even cash flows and the answer was exact the 3 years, the 4 years, the 5 years. Now, when your payback period is 3.2, 3.4, 4.8 means in decimal, then how you will going to calculate your payback period when your answer would be in this manner. Now, so calculate the payback. Company invest 1 lakh in project. So initial investment is 1 lakh. Expected now company again expected to growth. So year, first year, second year, third year, fourth year. All right. Now cash inflows. This is also uneven. 30,000 and then again 30,000. Now we will find what cumulative cash inflows. So first year you will receive the same amount 30,000. Then 30 plus 40, 70,000. 70 plus 20, 90. 90 plus 30, 1 lakh 20,000. And if you will add this, so you will get 1 lakh 20,000. Now, your initial investment is how much? Your initial investment is 1 lakh rupees. Now, when you will receive your 1 lakh rupees, now you will receive in between these two either from between 3 to 4 years. In between 3 to 4 years, you will receive your uh, cash, the payback period. You will receive your cash inflows that is 1 lakh rupees. Now, how much is extra? See, 90,000 you have reached 90,000 at third year. And in fourth year, that is 30,000 more is there. 30,000 more in fourth year. Till here, any doubt? All right. Now, so what is the gap? Now, how much we need extra? 90,000 is there and we need only 10,000 extra. How much is the total value? So it is 3 years plus how much is the total value from 90,000 to 120? What is the gap? That is the gap of 30,000. Now, if you will calculate, so you will get 0.33 years. So 3 plus 0.33, 3.33. So this is your payback period. So 3 plus 10,000 upon 30,000, that is 3.33. Now, if you want to know that, okay, we know that in 3 years, in third year, we will receive our initial amount. Now, what is the 0.33? Now, how to calculate? See, 0.33 into 12. If you want to find in how much month you will receive your payback period, so 0.33 into 112. So that is 3.96. So round about 4 months. So in 3 years plus 4 months, you will receive your initial amount that is 1 lakh rupees. Any doubt to anyone in this question? If it is, let's take an example. If it is 4.97, so 0.97 into 12 you will do. Whatever answer comes, that will be your month. So 4 years and let's do it 0.97 into 12. So 11. So it means 4 years and 11 months. Understood? So that is 3.33 years. 3.33, or we can say 3 years and 4 months total. Now, so one quick information for you all again. If you have not yet enrolled in our capsule classes, capsule batch, your last minute revision batch, where we will do one more time revision of all the entire concepts, the relevant concepts for ABFM. So we have completed till now, we have completed module A and the first unit of module B. So recordings are still there. If you want to enroll, do enroll in this session. So in 6 classes, we'll complete the entire ABFM paper. So if you are suitable for Hindi medium classes, then you can watch Pradyuman sir's class. And if you are suitable for watching my class, then you can join my session. Now, again, it is of red mark, so it is a previous year question. Question number 24. Which investment appraisal method corrects the unrealistic assumption of reinvesting interim cash flows at the project's own IRR and ensures only one rate is calculated? Now, the IRR, what it speaks about, see, IRR mainly says that whatever profits we have made from any investment, now we will going to reinvest that profit in the same investment. So you only tell me, is it possible that from any investment, like from in project A, you have made the profit of 10,000 rupees. Now, when you have made this profit 10,000 rupees, now next time, would you going to reinvest in the same project the same amount every time? Okay, one time you will invest, but not every time. So our internal rate of return says that every time when we will make the profit, we will invest in the same project. That is the reinvestment. So it is not possible in practical life. It is not possible that. So this basically this the MIR says that it is not always practical. So even with altering positive and negative cash flows, we will always invest in some other project, not in the same project where we have earned our returns. Modified internal rate of return, it is more realistic, it is more authentic, it gives you the accurate result as compared to internal rate of return. So it is done, modifications are done in internal rate of return, that is modified. So MIRR addresses the limitation of IRR by assuming reinvestment of interim cash flows at the firm's cost of capital. So not every time it is possible that whatever profits you will, whatever returns you are making, you will reinvest in the same project. Now, question number 25. Again, this is previous year question. Which statement is incorrect about preference shares or preference capital? So preference share means a preference is provided to them. Now, what are the preference? Whenever company will make profit, first dividend will be provided to preference shareholders. Majorly, these shareholders they get the fixed rate of dividend unless and until they are the floating preference shares. Then no voting right is provided. They have the option of convertibility. Then when the company gets liquidate, so liquidation amount is provided to them before common equity share. No extra commission or bonus is provided unless and until if they are participating. So what is incorrect? This is that part of capital which provides less risk to the investors as compared to equity. Yes. If equity is a preferred stock, preference share is a common stock. No. Equity is common stock. These are equity shareholders are known as the common shareholders. and preference is a preferred stock. They will get the benefit of dividend plus the liquidation amount. And it is a quasi-risk capital because it is not a quasi-risk means it does not consist all the risk. Half risk is there. Why? Because it is not safe as secured debts. So these are all the features of your preference shareholders. Now, next question number 26. You have to calculate NPV. Net present value. Cost is 50,000, generates cash inflow of 20,000, 15,000, 25, and 10,000 for 4 years. Now, discounting rate, present value interest factor is how much? 10%. You have to find the NPV. So, NPV is present value of cash inflows minus present value of cash outflow. Now, how to calculate the present PV, present value interest factor? 1 upon 1 plus R upon n. So it is 10%. So 1 upon 1.10. 10% is what? 1.10. If you will do equal to what value you will get? 1 divided by 1.10. 0.909. Again to equal to till 4 years. 4 years it is asking na. Again to equal to in that amount. So second is 0.826. Second discounting rate factor. Again to equal to, then it is 0.751. Again to equal to 0.683. Again to equal to 0.620. So this is for first year, this is for second year, this is for third year, this is for fourth year, this is for fifth year. Now project year is given 1, 2, 3, 4. Now cash inflows are, it is given 20,000, then 15,000, 25,000 and 10,000. This is your cash inflows without considering discounting. Now, present value at the rate of 10% is how much? 10% is first year is 0.909, second is 0.826, third is 0.751, fourth is 0.683. Now, calculate cash inflows after considering discounting the present value factor. So discounted cash flow is 20,000 into 0.9. So 20,000 into 0.909. So it is 18180. Then 0.6. So 12390. 751. So it is 18,775. 0.683, 6830. Now calculate this 18180, 12390, 18775, 6830. So it is 56,175. Now, okay, without considering, if you were not considering discounting, then how much cash inflows you were receiving in fourth year? So 20, 35, 45, 50, 60, 70. So 70,000. 20 plus 15 plus 25 plus 10. Okay, 70,000. Now, after considering discounting, after considering the time value factor, now how much cash inflows you will receive at the end of fourth year? That is 56,175. Now, so we have to calculate NPV. NPV is present value of cash inflows. Present value cash inflows is how much? That is Inflow is 56,175. Outflow is project cost 50,000. Now 6175. Again, this is in positive, so we will accept the project. So we will accept a project as NPV is greater than 0. That is 6175. It is in positive. So this is how we will calculate net present value. Any doubt? Wait, now it's visible. All right. So this is your explanation part. Now, question number 27. If a firm has high operating leverage, then high operating leverage means, so this question is very, very important. And how to calculate present value interest factor? Just to do equal to the rate. If it is, okay, in the question it is given 10%. If it gives you 12%, then 1 upon 1.12, then do equal to whatever answer come, then do again equal to, then do again equal to. So that is how you have to calculate your present value interest factor of all the years. Now, next, question number 27. A firm has high operating leverage means what? That a small change in sales will lead to a large change in EBIT. See, just now we have seen in this table, if you remember, this, that to analyze the sensitivity of EBIT due to sales. So high change in EBIT, if there is even a small change in sales, there would be high change in EBIT. Even if there is small change in EBIT, there would be high change in your EPS in financial leverage. If there is small change in sales, there would be high change in EPS. So small change in sale will lead to the big changes in your EPS, EBIT. So the same, so this is the question. A small change in sales leads to a large change in EBIT. Now, how? Let's have one example. Suppose a company is making shoes. Okay. Now, fixed cost is 1 lakh, variable cost is 200, and selling price is 300 per shoe. Now, 300 per shoe means one shoe cost rupees 300. Sales are total 1500 shoes. Now, if sales are 1500 and selling price is rupees 300 per shoe, then how much revenue the company will make? 1500 into 300, that is 4,50,000. Variable cost is rupees 200 per shoe. So 1500 into 200, it is 3 lakh. Now, contribution, sales minus variable cost, that is contribution. So it is 1,50,000. Now, EBIT is contribution minus fixed cost. Contribution is how much? 1,50,000 minus 1 lakh. That is your fixed cost. It is already given in full amount. Now, so your now EBIT earnings before interest and tax is 50,000. This is the normal scenario. Now, when we are increasing sales, now we are increasing sales only by 10%. Now, if sales is increasing by 10%, now 15%, what is the 10% of 1500? 150. So 1500 plus 150, that is 1650. Now, this is your sales. Now, everything will be changed. If you are making changes in sales, everything will be changed. So your revenue will also change. Now, when we were using 1500, now we will use 1650 into 300 into 200 and contribution. And with this, your EBIT is 65,000. So if you are increasing your sales just by 10%, just by 150 rupees, now your entire EBIT changes to 65,000. So sales is going only 10% and EBIT is changing from 50,000 to 6,500. So this is 30% increase. So 10% increase in sales, 10% increase in sales will lead to 30% increase in your EBIT. So it means A small change in sales will lead to big change in EBIT. So that was your question. So this is just because of high operating cost, high operating leverage. Option A. All right. Now, next question number 28. Four statements are provided to you. So net present value assumes it is a method discounts all your future cash flows at the project cost of capital and assumes reinvestment at the same rate. You have to find which of the following statements are correct. So yes, it discounts all your future cash flows at the cost of capital and reinvestment at the same rate. Now, statement 2, internal rate of return method assumes that interim cash are reinvested at the IRR itself, but it is not always realistic. And which says this? MIRR says this. Now, payback period method considers time value of money. No, it does not consider time value of money. Accounting rate of return uses cash flows rather than accounting profit. No, accounting rate of return uses your accounting profit rather than your cash flows. And it also ignores your time value of money. So this statement is also wrong because it says it uses your cash flows rather than accounting profit. It uses accounting profit rather than cash flows. So only statement 1 and 2 are correct. Option C. Now, question number 29. Three statements are provided. Activity-based costing traces all the overhead expenses to your activities and products based on their actual consumption. Yes, so it considers your each and every cost in each and every activity, how much cost the company is making in each and every activity. Yes, and then the cost pool will be made. Correct. ABC facilitates strategic decision such as identifying non-value adding activities, loss-making project products, improving pricing decision. So AB activity-based costing, it includes everything, the products which are giving you negative returns, which are not giving you any profit, the ABC helps to eliminate those products. ABC also helps you to identify which product to add, which product to avoid. This is also correct. Now, ABC incorporates both direct and indirect cost drivers. Correct. Therefore, it does not consider only direct cost allocation. No, it considers direct plus indirect both cost. So this is wrong. It says it does not consider only direct cost allocation. That is why statement 1 and 2 are correct and statement 3 is incorrect. Now, next question number 30. Cost, volume, profit, profitability decision. Company is producing 1,20,000 units. Sales are 60 lakh. Variable cost is 65% of sales and fixed cost is 6 lakh. Now you have to find contribution also, PV ratio also and profit. So three things you have to find. So first, contribution. What is the formula of contribution? Sales minus variable cost. So you have to find the variable cost. It is 65% of sales now. Sales minus variable cost, you will get contribution. So sales are how much? Just a minute. Okay. Now your sales are 60,000, 60 lakh, sorry. Now 60 lakh. And what is the 65% of 60 lakh? 60 lakh into 65%. That is 339 lakh. So 60 lakh minus 39 lakh, it is 21 lakh. Now this is what? This is your contribution. So we have got our contribution how much? That is 21 lakh. Now next is what? Next is PV ratio. Now what is PV ratio? Profit volume ratio. So it is contribution upon sales into 100. Contribution is how much? Contribution is 21 lakh upon sales 60 lakh into 100. So 21 divided by 60 into 100, that is 35%. So PV ratio is 35%. Now profit is sales minus variable cost is contribution. Contribution minus fixed cost is your EBIT. So contribution is how much? Contribution was your 21 lakh minus fixed cost 6 lakh. So 21 minus 6, it is 15 lakh. So your profit is 15 lakh. So PV ratio 35%, profit is 15 lakh and contribution is 21 lakh. So option A. Done. So all the formulas are also important. Answer A. Now, cash flow after tax, CFAT. How to calculate CFAT when PAT is given in the question, or if no PAT is given, then also how you will going to calculate CFAT. Cost of the plant is 5 lakh, life is given 5 years, scrap value, no closing balance, profit before depreciation, interest and tax is 1,75,000. Tax rate is 30%. Now you have to calculate the yearly cash flow. So cost of plant is 5 lakh and life is given 5 years. So first we will find the depreciation. So 5 lakh upon 5. So annual depreciation is 1 lakh. Now profit before interest and tax, this is given. So we have to find the profit after taxes. So what is given? 1,75,000 and tax rate is how much? That is 30%. So first we will find the, okay, 1,75,000. Okay, profit before interest, tax and depreciation. This is 1,70,000. So we will deduct the depreciation 1 lakh. How much is coming? 75,000. Then we will deduct tax. Tax is 30%. So 75,000 into 30%. That is 22,500 minus 75,000. So it is coming 52,500. So this is what? This is your profit after tax. Now, so we have got PAT. PAT is your 52,500. Now, when we are having PAT and we have to calculate CFAT, what we do in PAT? In PAT, we add depreciation in order to get CFAT. Why? Because depreciation is a non-cash item. So in this 52,500, we will add 1 lakh depreciation to get our CFAT. So 1 lakh is added, so it will become 152,500. So 1,52,500 is your CFAT. Now, suppose in same way, when suppose CFAT is given in the question, 1,50,500 is given, and you have to find average rate of return. So we know that average rate of return considers which kind of cash flow? Profit after tax. So in this, what you will do? You will deduct the depreciation. In profit after tax, you will add depreciation to get your CFAT. And if CFAT is given in the question, then you will deduct depreciation to get your profit after tax. So this is the rule. I hope this is clear to you how to calculate cash flow after tax, how to calculate profit after tax. So when PAT is given, and if you have to calculate CFAT, then you will add depreciation. If CFAT is given, if it is required to calculate PAT or average rate of return, because ARR considers PAT, so you will simply deduct depreciation. So 1,52,500. Now, question number 32. Make cost per unit. Material is 40, labor is 25, variable overhead is 10. Fixed overhead is per unit is given 15, avoidable only 50%. Means you have to use 50% of the factory overhead expenses. And supplier is offering price at 72 per unit. One unit cost rupees 72. So what you will do? Either you will going to make that item in your company, or you will going to buy from outside and then you will sell. So first you have to calculate what is your cost when making that item. So material is 40, labor is 25, variable overhead is rupees 10, and fact fixed overhead is given 15, avoidable only 50. So we will only 50 it is avoidable, but we have to use 50%. So what is 50% of 15? 7.5. Now calculate. So 40 plus 25 plus 17.5. So 82.5. Now, so in order to make one unit, what is your costing? It is your 82.5. And if you will purchase from outside, from supplier, supplier is offering you 72 per unit. Now, so which method you will choose, which way you will go? Either you will make that product or you will buy that product, because buying is comparatively it is cheaper than making your product. So you will go with the buying option. So you will buy the product. Decision would be buy. All right. Now, next question number 33. Then we have 34. Two questions are left. Again, this question is of red mark. So this is your previous year question. Paid up share capital, forfeited, authorized, and subscribed. Forfeited, authorized, and subscribed. Now, what is paid up capital? So paid up capital, it is the capital, the amount of money a company has received from shareholders in exchange of shares. The shareholders, they have paid the amount. Now, forfeited shareholders means the company have given the shares. Now, those who have subscribed to the shares, they have not paid the full amount. So, in that case, company will forfeit its shares. So, subscribed capital which is not fully paid as required. So, the board of directors will forfeit those shares. Authorized share capital is known as registered share capital. It is the maximum amount of share capital that company can issue in its lifetime. And subscribed means the amount, how much the amount the investors they have subscribed, they have issued share capital that is subscribed by the public. So company has issued a 10 rupees and investors have subscribed only 6. So this is what, this is your subscribed share capital. So 3, 4, 1, 2. Option A. Now, last question number 34. Compounding and discounting. What is the difference between discounting and compounding? So finding the present value of all your future cash inflows is discounting, and finding the future value of all your present cash flows, that is compounding. So discounting calculates the present value of future cash inflows, while compounding calculates the future value of all your present cash inflows. So option A. This is the difference between discounting and compounding. Now, so compounding means what? Making your money grow. So finding that how much your money will grow in future. Suppose example is if you put 1000 in bank at the rate of 10%. So after 1 year, how much amount you will get? So it will become your 1 lakh 1100. After 2 years, again the same rate of interest 10%. So 1100 plus 10%, it will give you 1210. So because you earn interest on interest too. So that is growing your money in future. So what value you will get in future. So finding out how much money you will grow in future. If you are investing in today's term. And the opposite of compounding is discounting. So bringing future money to today's value. So finding out how much future amount is worth today. Finding the present value of all your future cash inflows, that is discounting. So if someone promises to give you 1100 after 1 year, now what is its value right now? So how much that value is worthy today when the rate of interest is 10%? So answer is 1000. So that is, if you are going from future to present, you will reduce money. If you are going from present to future, you will grow your money. So that is discounting and compounding. So answer option A is the correct answer. All right, and so with this, we have completed our 34 questions today. And every question is important because I have added all the numericals, one question of all the topics. Either it is APT, only one question was one numerical left for spot rate that we will do in paid class today. Okay, the NPV, then uh, accounting rate of return, payback period, profitability index is also left. These two topics are left. We will complete in paid class. Rest all the topics, all the numerical portion I have added in today's session. And if you have not yet enrolled in our capsule batch, do it now. This is for Hindi medium, Pradyuman sir will take class, and for English, you can watch my session. And if you feel sessions are helpful, do like the session, subscribe the channel, and share it with others as well. Don't forget to like and share the video. All right. So let's meet you in tomorrow's session. So tomorrow also 8:15 a.m. in the morning, and we will do our module C. So in module C, all the topics, all the questions, all the type of question we will do in tomorrow's session. So that will be also about 35 questions we will do because numerical portion is there. All right, chalo, let's meet you tomorrow. And today at 7 p.m. in the evening, we are having our third lecture of capsule batch. So where I will try to complete the entire module B in today's session. All right, chalo. Bye bye everyone. Take good care of yourselves. Let's meet tomorrow and at evening 7 p.m.